Now they're joined by none other than Goldman Sachs' CEO, Lloyd Blankfein. Guys?
Thank you so much, Betty. Lloyd, in 2009, Goldman Sachs set the record for trading revenue. Last week, we looked at the numbers, and they are worse than they have been in a decade. What is happening in trading? Have you lost your groove?
Oh, my goodness. It's very funny because so much has changed in the month since since the half a month since last year ended. We did fine in trading. Our ROE was pretty good in a market which was otherwise marked by low volatility and low volumes. And if you recall, the headlines from just a month ago were the markets, people were withdrawing from the trading businesses. The markets would never move again. They had an intellectual underpinning for it because the central banks had put so much liquidity, acted like a blanket on markets. And you roll the clock forward to today, and it's a massive amount of volatility, a massive amount of volumes going through, people needing to adjust the portfolio. And all of a sudden, there we are again, acting as an intermediary in difficult markets, helping our clients do things. So the fact of the matter is we did very well in trading each of the last several years. Obviously, '09 was a record. But by the way, just to remind you, in '08, which was the horrible year, I was being asked, are we getting out of investment banking, are we getting out of trading, because there was no more need for intermediation or investment banking services. 5 minutes later, '09 was the record year. So here we were writing off the sales and trading businesses in 13, and here we are in 14, where we're able to help our clients navigate very difficult, complex, and quite active markets.
Lloyd, what does it say about the environment in which Goldman Sachs is operating and your industry that 11% ROE is, I think in your words, pretty good?
I think you meant 11.2%. ROE.
We should be precise.
Well, I tell you, I'm in the precision business, and those last 0.2 were very hard. It took a lot of work.
I'm
sure they were.
Thank you.
So what does it say?
I'd say that we're still in a period, apropos the last question, we're still reeling, and I say we, I mean the world, from the effects of the very big trauma. Growth is still slow around the world, accelerating in the United States, hardly robust in Europe. In other words, very calm, very low growth in Europe, very ambiguous where China is coming out now. And everything that we do, our role, our social role, our economic role, and in fact the ability to earn money comes from, with us, confidence and correlation with growth. And so a low growth or a slow growth environment is not going to be the optimal set for us. As markets grow, people do engage in activity, we advise them, we manage their risky assets, and we finance them.
What does your social role actually mean? Because I hear social role from you, the CEO of Goldman, when I speak to traders, salespeople, bankers. I never hear about the social role. And when I'm on analyst calls, no one talks about it.
Well, you don't talk, the nature of an economic system is everybody pursues their interests, and the collective pursues the interests of the whole. We finance growth. People come to us, ask us how to invest their money. Other people come to us with ideas who want to finance their activities. We're early investors in Uber and Alibaba, clean tech companies, all sorts of companies that today provide a lot of important services and employ a lot of people. And we, by putting our money to work, we also bring in other people's money who look to us to manage their money. And so we are that nexus between those who need capital and those who provide capital.
Do you still believe in Uber, even though it's in such a beatdown right now?
Do I believe in Uber? When I take out my phone, press it, and the cab shows up in a few minutes, do I believe that cab is real, and do I get in? Yes.
But
do you believe in tech valuations at these levels?
Uber is a private company. It does financings at given lessons.
Not just Uber, everywhere.
Yeah, I think they do financing. I'm not sure it's a liquid. We'll see about these things. Things don't have a value because I designate it. There's a market for these things.
Sure, but you've seen
the answer is
things
I
go
think
up and
it
down.
is a very big disruptive force. It does a great job.
I'm not just talking about Uber in general. Technology valuations.
It's hard.
Particularly in the startups.
I will have a very clear answer in hindsight.
Good answer.
Yeah.
Listen, when we talk Uber, it makes me think regulation. Regulation makes me think banking. When we hear from guys like Jamie Dimon, it makes it sound like the supervisory
guys like
pressure.
Jamie Dimon, you mean Jamie Dimon?
Correct.
Yeah.
The pressure banks are under from the regulators just seems oppressive at this point. Would you agree?
Well, I don't know. I feel pretty, I feel pretty sunny.
You do?
Yeah. I mean, it's a fact of life. We're dealing with regulation, regulatory.
When you think regulation, you feel sunny?
No, I'm just saying in general, you say oppressed. I mean, God, I'm not bowed over by it. It's part of the background we're dealing with now. It's the background noise. It affects almost everything we do. I can't think about our technology spend without thinking of the number of heads I have to hire to build the systems to comply with the new regulatory reporting functions. So it is a fact of life, but no choice, no problem. It's something that we have to deal with. If you ask me how much time do I spend thinking about regulation and rules and that kind of compliance, all the time. But it doesn't push out other things. It's like background noise. It's like music. You ask me how much time do I spend listening to music? A lot of time, but I'm doing other things at the same time. So I'm thinking about regulation, and I'm also thinking how to finance our clients.
What about bond market liquidity?
Yeah.
Is that an unintended consequence of regulation, the lack of liquidity that some people perceive in the bond market?
I personally think that as the markets get active, liquidity will follow the demand and people paying for liquidity. But all other things being equal, in an environment where more capital is charged for holding inventories, and there are more expenses and burdens attached to trading, I think it will be more expensive, and therefore, for the same price, there'll be less liquidity. But as the demand for liquidity comes up, and as people pay for more liquidity, you'll see people, unfortunately, because we're a big liquidity provider, and I'd like it to be a seller's market, you'll see liquidity providers will again come out of the woodwork. Take, for example, you referred at the beginning of the conversation to 2009. 2008, everybody was prostrate. Nobody wanted to trade. Nobody wanted to take risk. We did very well in 2009 because we were one of the only people left providing a lot of liquidity to clients who really needed it.
But you were allowed to back then. We
were allowed to then, but it was a seller's market. And guess what? We did very well in 2009. Competition came, a tsunami of competition came back into the market, and it'll come back in again.
Then do you think if we continue to see this kind of volatility, Goldman's going to have a huge year?
I think that our success will correlate with growth. Growth will run into confidence. As people do more transacting, they'll have to rearrange their portfolios, buy things, hedge things, and that's generally positive for our P&L.
Liquidity will be more expensive. Who pays for that? All things being equal.
Well, the consumers in the market. And at the end of the day, look.
What does that mean, the buy side?
Of course. You could buy safety, but safety comes at a price, an incrementally higher price the more you want it. Now, we've just come off a big trauma, and one would say, I want to make sure this or that bad thing never, ever happens again, even in the 10,000-year storm. Well, the price for that is going to be much less leverage, so much less leverage, and so much cost and so much accumulated capital to back every transaction that it'll make transacting more expensive. That won't change because the intermediators like ourselves complain about it. It might change if the users of the market aren't able to access the market at what they think is at a reasonable rate. And at the end of the day, nobody wants to go out to excessive risk, but nobody wants excessive caution that results in too high a price and too expensive to accomplish people's growth objectives.
If we go back to the point that you made about the world still reeling from the financial crisis, yes, even though we see pockets of improvement.
I think it's improving. So reeling it may be diminishing, but we're still highly affected by it.
So once we get back to normal, and I don't even know what normal looks like, what does that mean for your firm? What's Goldman's ROE in a normal environment?
There's never, everyone's saying, don't you know everything has changed radically? And I say this, things never stay the same, and they never change that much. And so everybody who's saying, and so, in our plan we said, we're still a liquidity provider to the market. We're still in investment banking. We haven't gone out of a lot of things. We've gone out of some things that are very capital intensive, but we haven't gone out of our basic businesses, nor have we added really new basic businesses. We think that we're an institutional, and I think the returns of that business have always been very good. And by always, I mean forever. We're in the intermediation business. There are people...
Well, once upon a time, they were 40.
I don't remember that time.
Or 20 plus. I mean,
20,
certainly,
yes,
it's got to be better than 11, right?
I remember that time.
Okay, so...
11.2.
11.2. It's got to be better than 11.2.
I think they can be... there's no reason to think they wouldn't be better. Again, what do you think about the environment? Are we living the golden age of investment banking opportunity right now?
Are we?
I don't think so. I don't think so either. You have China's an economy that is almost the size of the U.S. economy, soon will be bigger, and that's going through a slump. Europe, which is a bigger population than the United States, is coming out of a slump and still grinding. Could those opportunity sets be better than they are now? Absolutely. I don't know whether this is a third quartile opportunity set or a lower second quartile, but it's not the top decile opportunity for our business.
All right, we have to leave it then. But are you more positive in 2015 than you were in 2014?
Yes, I am.
Yes. Lloyd Blankfein, thank
you very
so
much,
much
Stephanie.
for joining us.
Thank you,
Chairman
Lloyd.
and CEO of Goldman Sachs, Lloyd Blankfein.